听见资本本期视频为您带来的是摩根大通在4月11日录制的关于全球汇率市场的内容，主题为动荡一周后外汇市场的变与不变。最近市场波动很大，你是不是也感觉到了？美元好像突然不香了，特别是对欧元汇率飙升，创了几年新高。这背后可能不只是简单的市场调整，而是美国例外论正在持续消退，资金流向也面临风险。有观点甚至认为，美元正显现出一些令人担忧的类似新兴市场货币的特征。同时，全球贸易紧张局势虽然在某些区域有所缓和，但对全球增长和贸易的长期负面影响已经造成。特别是中美之间的摩擦不仅没停，反而可能加剧，这对依赖贸易的新兴市场来说绝对是个坏消息，他们的资产正面临刻石般的致命打击。在这种背景下，人民币的走向尤其值得关注。有迹象表明，人民币贬值压力窗口已经打开，中国央行似乎在引导可控的贬值，目标可能指向 7.60。 这对全球贸易格局和亚洲货币市场意味着什么？欧洲内部也出现了分化，欧元因为成了反美元的选择而走强，但英镑则可能面临滞胀风险和财政压力的双重打击，前景堪忧，对欧元可能进一步走弱。这次讨论深入剖析了这些复杂局面，揭示了当前市场波动背后的深层原因、潜在风险以及对各类资产的影响。如果你想了解这些正在发生的重大转变，以及它们可能如何冲击你的投资组合，接下来是英文全部内容。如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Hello and welcome to this week's At Any Rate podcast. My name is Pat Locke from the Global FX Strategy team, joined today by Arindam Sandilya, co-head of Global FX Strategy based out of Singapore, and James Nelligan, senior strategist based out of London. Boys, thanks for joining. Look, so we may be out of the acute crisis period for markets from earlier this week, but we're obviously still seeing some pretty major moves kind of in the back half this week as well. Certainly in our space, we've had some pretty big swings in cross yen, cross Swiss to kick off the week. Dollar CNH notched 740 for the first time. But I'd say as well on the back half of the week was obviously kind of more dominated, I think, by euro dollar, which has exploded up through 114, which is the highest level in about 3 years. We had turned more obviously bullish on euro dollar and bearish on DXY back in March, due in part to kind of the ongoing erosion of U.S. exceptionalism and kind of the attendant flow risks, which I think ultimately this week do little to discount. But even then, kind of the dollar move has been pretty aggressive over the last couple of sessions. And of course, that's transpiring against a rates backdrop that remains, seemingly rather fragile. There were some kind of like technical considerations this week with basis trades, it sounds like, but it does look like rates will end up the week substantially steeper than where we started. And it's not entirely clear to me that it's proving to be all that good of a signal for the dollar itself right now. So with that, Arindam, let me turn it over to you. Interested from the policymaking and kind of global macro perspective, what did we learn that's really new this week after the walk back, and what stays the same for you this week as well?
Hey, Pat, feeling a little winded after that week. I think our economists had a good label for this the other day. This is the beginning of the end, but nothing more. I think it should be reasonably uncontroversial to think, as you alluded to in your comments, that the intensity of the trade conflict with the rest of the world, ex-China, has plateaued, if not peaked. I think the likely direction of travel from here on is towards negotiated bilateral deals that should cool financial market vol. It's not a given by any stretch that all will end well, but it's natural to look at vol markets like VIX and see that we've dropped 20 points on the week. So that's kind of intuitive. I think the U.S. administration has clearly demonstrated its sensitivity to domestic growth and market sentiment. So it's heartening to see that guardrail on policymaking still exists. That also perhaps bodes well for USMCA negotiations that should allow for North American asset risk premium to subside. I think the undoing of 10% universal tariffs on Canada and Mexico, there was some confusion on this earlier in the week. That shows that the treatment of this bloc will be different from the rest of the world because there are direct ramifications for U.S. growth. But beyond that knee-jerk, I think the chronic medium-term headwinds are still very much there. Compared to April 1st, before the reciprocal tariffs dropped, I don't think anyone will disagree that the U.S. cyclical outlook is worse because a healthy amount of sentiment damage is already done. I don't know how you go back. Inflation expectations in the U.S. will be higher and stickier than pre-tariffs, which will continue to weigh on the U.S. real yields and therefore what it means for the dollar. And whatever level at which the tariffs eventually settle, they will end up being manifold of what they used to be before all of this happened. So that will doubtless hit global trade, hit global growth, and that cannot be good news for trade-dependent parts of the world like EM. Beyond the cyclical element of the U.S. outlook, these perceptions of extreme U.S. policy uncertainty, despite the ratcheting down of tariffs over the next 90 days, they've only become more entrenched, I think, and that is having and will continue to have effect on how investors perceive U.S. assets and in our space, the dollar's traditional safe haven status. Clearly, trade frictions with China have not changed. If anything, they've intensified. It beggars belief that we are now talking about 145% tariffs on China. So on a relative basis, that should keep China and the rest of the Asian trading bloc on the back foot. There are question marks around how really impactful that headline tariff number is, though, because transshipment as a channel has not yet been closed. So long as that opens, I think there is a way for China to kind of absorb the hit from these punitive headline tariff numbers. We got some headlines out of Asia this morning along the lines of countries like Thailand and Vietnam tightening rules of origin regulations for U.S. exports, which is presumably designed to mollify the U.S. On this transshipment issue. And I think this is going to be quite important going forward. We'll see how this turns out in practice. But talking off of the transshipment outlet for China will have massive ramifications for how overall trade negotiations turn out, and there will be significant impacts on the market in terms of CNY and Asian FX. And finally, I don't think this week's tariff relief will have any bearing on how the rest of the world sees its need for greater self-reliance in economic and defense policy. I think the Europeans will continue to push ahead with fiscal, and I think the market will be happy to play up the German fiscal pivot. Yeah, so I think in my accounting of what's changed versus what's not, I see more things remaining the same. But of course, at the margin, you'll have to give credit to U.S. policymaking in terms of cooling the immediate fears of instability.
Yeah, thanks for that. Hard to disagree with much, if any, of it. But I think kind of like broad strokes, what do you kind of like, how does that ultimately map then to the dollar trade weighted index? And I mean, have you been surprised at the level of kind of like dislocation between dollar weakness versus G10, dollar outperformance against EM? And you mentioned dollar CNH. It sounds like we've marked up our terminal rate forecasts in dollar CNH or dollar CNY to 760, just as this kind of like, bearish trend in the dollar versus euro, for example, starts to look a little bit more entrenched. How do you square those two? Is one a risk for the other? And more generally, what are you looking for exactly in the PBOC's reaction function now that they've kind of shown their hand a little bit with the 720 fixes there?
Yeah, sure. A lot of questions, all very germane, and not always easy to answer. And I think the dollar weakness this week is sparking some talk, and understandably so, that it's displaying some EM-like characteristics. We've had the U.S. currency, the U.S. equity market, and the U.S. bond market all selling off simultaneously, which is very sort of problematic EM-like. And then you look at the twist steepening of the USD curve with the front end being hostage to the weak growth outlook, but the long end selling off, baking in more term premium. That's not a good look for the dollar, right? And it's all very far from the exceptional days at the turn of the year. That seems like a lifetime ago. It's impossible to handicap how far this extends, and I'm kind of personally reserving judgment on that. Speaking to clients, I'm finding myself on the less alarming end of the spectrum, if you will, on what this structurally means for the future of the dollar and U.S. as a safe haven destination. For me, I'm trying to view this as sort of plain vanilla deleveraging at this point. I mean, that is the definition of the word. People sell what they're long when they de-risk. I think the structural arguments around the dollar's loss of safe haven status has some merit. But my own inclination is let's treat this as a cyclical dynamic. And I'm unwilling to write off the left-hand side of this dollar smile entirely just yet. Although if you look at last week's performance, you could certainly argue that the LHS was definitely less visible than what has been the case in the past. So we shall see where we end up. But right here, right now, staying bearish the DXY as we are does not require overreaching on any structural arguments. So I think plain vanilla cyclical will do. I think the bifurcation between DM and EMFX makes total sense to me. Nothing in what we've learned over the past 2 weeks is constructive for global trade by any means. And global trade is the lifeline of EM. Right? And in addition, you have financial market vol ratcheting quite significantly higher. So that combination, weaker outlook for global trade and higher financial market vol, that's like kryptonite for EM assets. And the only saving grace for that block is that we are not going into this downturn with the market massively overbought on EM assets and EM assets highly overvalued. So the net result could be that we get a milder EM downturn than what we've had in previous episodes, but I don't think that upends the direction of travel for EM. But for G10 on the other side, if you go back to the combination of weaker dollar, weaker S&P, and weaker US bond markets, you might be surprised to hear that there have been 50 plus monthly episodes of such occurrences since the advent of the free floating exchange rate era. And what tends to happen during those months is like textbook: the Swiss rallies, the yen rallies, euro rallies, and gold rallies. And cyclical assets, EMFX, Aussie, Kiwi, CAD, copper, hard metals, etc., performance is a lot more mixed, right? So the sort of tremendous performance that we've seen from the likes of Swiss yen and the euro this week is entirely playing to script. On China, my experience sitting in this part of the world has been that we live and learn, right? For everything CNY and CNY fixing related, just watch the evolution of the fixings. That is the policy signal. PBOC is clearly telling us that there is a window now here where they're looking to incrementally, in a very controlled fashion, willing to let some steam off the natural depreciation pressures on the currency that might be coming through because of these, massively punitive tariffs. What does history teach us? History teaches us that these kind of mini phases of CNY fixings will tend to last for anywhere between 1 to 3 months. I think we are very early stage in this shift. We think that a controlled depreciation of the CNY via the fixings can push us towards 750, 760 over the next 3 to 4 quarters. And the way you get to that number is our math tells us that every $100 billion drop in BOP inflows into China contributes to something like 1.5 to 1.7% weakness in the CNY trade weighted. Presuming that correlation holds, if the entire U.S.-China trade kind of comes to a sudden stop, that's about a loss of $300 billion for the Chinese BOP as a direct hit. And that leads to a 5 to 6% drop in the CNY-TWI. And then you map the CNY-TWI to dollar CNY, you think that the basket heads somewhere towards 93, and that's kind of consistent with dollar CNY, somewhere in this 7.5 to 7.6 range, right? So that's why we have penciled in, 7.6 as the terminal on dollar CNY in our forecasts, but, very humble and very mindful that there are plenty of non-linearities where these point forecasts can prove horrendously off the mark.
Very good. Thanks, Arindam. James, let's bring you into the fold. Obviously a pretty wild ride for Eurodollar into the end of the week. How have our views kind of evolved around that? Are we increasingly bullish or just kind of like seeing it generally in line with kind of the forecast that we had in place? And then more broadly, you cover kind of the rest of the European FX complex. What are the kind of the net delta and views there? And where are you most constructive and least constructive?
Sure. Yeah. At the risk of kind of repeating what Arindam has said, I think this week has been a bit of a culmination in terms of like some of the messages we've been trying to send on Eurodollar. Kind of, despite the growth hit to Eurozone from the tariffs, there's a bit of a bigger picture theme going on around relative attractiveness of dollar assets in a world where you have more volatile policy making. in a world where the relative growth move on tariffs is a bit more debatable if the US administration is, placing broad tariffs on all imports, where investors have been overweight US assets heading into what, has been moderating US exceptionalism. So we're seeing the euro-dollar move being, less about an improvement in European growth, although, there is some marginal relief there if you think about pausing tariffs on the Eurozone, etc. But it's much more about the euro being an anti-dollar, a reserve currency, a currency which can benefit from repatriation or rotation away from US assets into European assets. We've been mainly focused on the equity channel there, as European investors bought the most US equities over recent years. But this week, it's been probably more about the rates channel. And, yes, we can say that it's exacerbated by deleveraging in illiquid markets and, rates flows are largely FX hedged. But, as our rate strategist, Jay Barry, put it in his daily publication on Monday, there are questions being asked around foreign demand for treasuries showing up in higher term premium. And that in our view does imply some dollar risk premium. And we could go on here talking about in terms of, if Trump wants to get trade deficits to zero, then what does that say for the kind of usual recycling of capital into treasuries? What does, potential US recession do to the US fiscal risk premium, given that, this is going to be the first cycle where the unemployment rate is relatively low relative to a high budget deficit, etc. But, let's just keep things tight here and say, I think the Eurodollar bullishness is partly a function of just seeing euro as an anti-dollar reserve currency, and that's really where we stand on this. In terms of the rest of the European complex, you asked about, I think in terms of highest convictions, I think the conviction in the bearish sterling view has increased. I think particularly on euro sterling, where we kind of made this point of upping the conviction level heading into this week. And fortunately, the timing was okay on that. We did see, obviously, gilt yields rising quite aggressively on the back of the sell-off in treasuries. And, instead of sterling appreciating on higher UK gilt yields, we actually saw the stagflationary reaction function kick back in, like we saw in January, around the implications of higher UK yields for the UK economy itself, for the fiscal maths, and we saw that kick in for sterling in terms of the currency weakening. But ultimately, for the currency, the market knows that given the impact from the global tariff package and rising global recession probabilities that our economists are talking about, then there's going to come a point over the coming quarters where the fiscal situation in the UK is called into question again, and the prospect of fiscal tightening into a growth slowdown is not really a healthy mix for the currency. So we did see our UK economists downgrading growth and lowering BOE terminal this week on the back of that. If you throw in some souring in risk sentiment, which is typically bullish for euro sterling, then some euro demand from the dollar move, as we discussed before, then you've got a pretty strong mix for euro sterling. So we wouldn't be surprised to see the pair kind of testing up towards 90 pence at some point later this year.
All right, thank you both. I think we'll leave it there for this week. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025 JP Morgan Chase & Company, all rights reserved. This episode was recorded on the 11th of April, 2025.